In this video, I'm going to demonstrate recording a known liability using exercise 9-2 as an example. So we have Piper Company on July 15th going to make a sale at the value of $130,000 of merchandise. The merchandise costs Piper $75,000 and they're receiving cash in exchange for the sale. Also, we need to factor in that there's a required sales tax rate of 5%. Now, some of this probably already seems familiar to you. If you go back to chapter 4, when we dealt with a merchandiser, in particular, when we dealt with recording sales using the perpetual inventory system for a merchandiser. You may recall we would have two separate journal entries, one for the sales value itself to record the sale, the second one at the cost to record the expense and also the removal of the inventory. We're still going to have those two separate journal entries. We just need to make a little bit of a tweak to one of them for the sales tax that also needs to be collected. So what already should seem familiar? We need to credit sales at the sales value of $130,000. Sales is a revenue account. We increase it with a credit. Here's where things are going to change though. We also need to credit the sales tax payable account. Why are we crediting that account? Because Piper is going to collect sales tax on the behalf of the government. Let's say that this is a sale happening in Indiana, so they're collecting sales tax on the behalf of Indiana. It's not earned by them. It's not something they record revenue on. They're simply a pass through. And until they pass along those funds to that government, it's a liability. It's an amount owed to that government. When you see the word payable, think liability. So we're increasing the payable account or liability account. So we're going to credit the account. How do we come up with the value that we credit it by or the amount of sales tax we're going to charge? We take the total sales value of 130,000, multiply it times the sales tax rate of 5%, which is also you see here is 0.05. And so the total amount of sales tax that Piper is going to charge and collect, again, it hasn't earned, it's a liability, is going to be $6,500. So the total amount of cash received is the combination of the sales value of 130,000 and the sales tax collected of 6,500. So total cash received is 136,500. That's the amount we're going to debit to cash. Cash is an asset, so we increase it with a debit. Now, we also need to make that second journal entry because Piper uses a perpetual inventory system. That entry is completely unaffected by the sales tax. We're going to debit cost of goods sold and expense account for the cost of the product to Piper Company of $75,000. We're also going to credit the asset account merchandise inventory. We increase assets with debits, decrease them with credits. So we're going to decrease merchandise inventory for $75,000 because it no longer has this merchandise inventory. So we've taken care of our entries on July 15th. We're not done yet. I mentioned Piper can't keep the sales tax amount of $6,500. Again, it's just a pass through. It's an IOU or payable until it remits it. It's going to come along on August the 1st and remit the sales tax that it collected from the government. So on August the 1st, it's going to decrease that liability account. We decrease liability accounts by debiting them. So we're going to debit sales tax payable for the $6,500. We're also going to credit cash because they're going to pay the cash, that much less cash. They initially received it. Now they're paying it off. So credit cash for $6,500. At this point, they fulfilled their obligation. There would be a zero balance in sales tax payable and equal debit and credit. Sales tax payable is known as an example of a known liability. A known liability is typically there's an agreement, there's a contract. We know exactly what the dollar amount is. We know exactly who to pay, and we know exactly what time frame to pay. There's no uncertainty of it. So this is a good example of a known liability. Now I want to look at a completely independent scenario. So on November the 3rd, the Milwaukee Bucks sold a 6-pack game of advance tickets for $690 in cash. And I'm going to stop there. So initially on November the 3rd, we're going to first debit cash an asset for $690. We're recording this from the perspective of the Milwaukee Bucks. You may initially have said, oh, like in the first transaction, I credited sales, so I need to credit some type of revenue account. But in the first scenario, Piper had actually earned the revenue. It had provided that product to its customer, whereas the Milwaukee Bucks have received cash and they still owe their customer playing those particular games in the future. So they're going to credit a liability account called unearned ticket revenue. Anytime we attach the word unearned onto revenue, we transform it from a revenue to a liability. Crediting that account for $690 increases the liability or the obligation. It's going to reside in that account until they start playing games and provide that service to their ticket holders or their customers. On November the 20th, the Bucks are going to play the first of the 6 games. So only one. This represents 1/6 of the advanced ticket sales. So one thing we're going to do is decrease that liability account we originally increased, and we decrease a liability account with a debit. So we're debiting unearned ticket revenue. The amount we're going to debit it by isn't the $690 because they didn't fulfill all 6 games, just one. So we're going to take 690, multiply it times 1/6, again, just one of the 6 games, and debit the account for $115. At this point, unearned ticket revenue would have a balance of 690 minus 115 or $515, representing the additional 5 games that they still owe their ticket holders. We can't leave a debit hanging without a credit, so we are going to also credit, finally, a revenue account called ticket revenue to represent the fact for $115 that they have fulfilled now 1/6 they played one of the games. This is also an example of a known liability. They know who their ticket holders are, they know the number of games, they know the value of the game, so again, there's no uncertainty.